Our first question to you is, how would you rate the budget speech yesterday with the kind of reactions that have come in so far as well?
Thanks a lot for inviting us. So budget, I think, was quite focused, and it was largely a continuation of previous budgets, if you see. So in the last couple of years, the government has been focusing on improving the manufacturing capacity, focusing on data centers. This budget, they also talked about rare earths, etc. So despite them expecting growth at 6.5% to 7%, they had a chance to consolidate much more meaningfully on fiscal. But they continued, the focus on public capex, and that's why we saw the 12 lakh crores capex announcement as well. And so I think overall, I would say the budget was quite growth oriented, and it's taking into account the external, vulnerabilities that we are facing right now. So it's trying to bulletproof the economy with those regards.
Well, hi Anurag, Sharad here, and of course RBI is also trying its best to, bulletproof the economy, especially with the volatility we are seeing in the fixed income market. But yields, there was a sharp spike today after the budget reaction coming in. Of course, the borrowing angle is definitely there. What's your take on that?
Right. So like I said, given that growth was quite expected to be quite strong in next fiscal year, the market was expecting a much more meaningful fiscal consolidation. So they were expecting the debt to GDP to go to 55% and probably fiscal deficit to be somewhere close to 4.1, 4.2%. So the gross borrowing number that the market got, which was 17.2 lakh crores, was a tad, I would say higher than what we were expecting, probably close to 16 to 16.5 lakh crores. And that's why we are seeing the sell-off. Because next year we again have the pay commission award, which will again push up the fiscal deficit. So in those regards, if the government has to reach to 50% by 2031, and we're already at this 55.6, so it's a very, very tough journey, especially if you consider the pay commission. So unless and until the nominal GDP growth picks up by 13-14%, it's difficult to reach that 50% mark by 31. So probably the direction and the way the borrowing number came caught market by surprise.
So do you think then the market, how will the market actually absorb this kind of additional supply that comes in? Or, will the RBI need to step in with regards to OMOs as well to come and anchor these yields then?
Absolutely. We think even next year, RBI has already done more than 6 lakh crores of OMO this year. If you look at the BOP trend and assuming no major US-India trade deal, probably next year also we could see a BOP deficit. So in that kind of scenario, we are expecting RBI to do at least 5 lakh crores of OMO next year as well. And we also expect additional demand to come from pension fund managers. So mind you, this year, because of the change in asset allocation pattern, the pension fund managers did not participate meaningfully in the government bond market. So we do expect next year incremental demand from them to come about 1 lakh crores. So overall, from a demand-supply dynamics, we think overall situation should be fairly balanced. If you look at the bank's demand also this year, it was very, very muted because they were focusing a lot on credit growth. But if you look at their SLR holding this year, now it has been at the lowest it has been in the last 5 years. So we think even bank demand on government bonds should come quite meaningfully next year.
And Anurag, just to put that in perspective, there has been a lot of rating upgrades also coming in, and the entire community was waiting for some big flows coming from outside as well. Will that start happening in? There's going to be some kind of index management as well?
So a lot would depend on the direction of INR. Because foreign investors, when they come typically into bonds, they come unhedged. So assuming a 3.5% depreciation, our spread compared to the US or the risk-free rate is not really material right now. So they need to see some stability on the currency front, which will probably come once we start seeing some positive direction on India-US trade deal perhaps.
So okay, with all of this said and done, how are you looking at the liquidity management from here on? Because we're looking at strong credit growth. There is a heavy government redemption calendar of what, 5.5 lakh crores as well. How will that actually impact your banking system liquidity if you have to look at from a FY27 perspective then?
So as per our estimate, we should end the year with 3 lakh crores of surplus liquidity. And if you look at next year, typical currency leakage in an annual year is about 4 lakh crores. If you add in, probably because of FX outflows, again 2.5 to 3 lakh crores and some CRR leakage. So probably we are, like I said, we are estimating about 5 lakh crores of intervention from RBI just on the bond side, on the bond buyback, and probably we expect RBI to continue to do VRRs to provide temporary liquidity to banking system. So I think RBI has been quite serious that it wants to maintain liquidity at a positive 1% of NDTL, which is about 2.5 lakh crores. So we expect that RBI will continue to maintain that in next year as well.
And the last one is the RBI MPC meet is also coming, and just like to take your views on it, because inflation is also there. It's benign right now, and there's a change happening in the food constituent as well. So how do you see these factors moving, especially for the RBI MPC meet?
So if you look at broad picture next year, and I think if you look at RBI, they always look at forward-looking inflation. Next year, inflation is likely to average around 4.5%, even after the new CPI
So it
series.
remains in that band.
It largely remains in that band. So unless and until it really changes materially, we expect RBI to stay put, and we expect policy rates to remain lower for longer. It's largely like a post-COVID scenario. So if you remember in 2021, after cutting rates, RBI kept the rates at a lower rates for longer and kept liquidity high. So that's the kind of scenario we see it playing out this year as well.